Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a family office network based in Greenwich, Connecticut. Our next family office summit in New York is on October 8th and features Peter Krause, founder of Aperture Investors, and William Cohan, who is the author of the upcoming book about the history of Apollo called Money to Burn. And today I'm very fortunate to be joined by Michael Gross, CEO and president of SLR Corporation, who was present at the birth of Apollo. Michael co-founded SLR alongside Bruce Spohler in 2006, and the firm now manages roughly $14 billion across cash flow lending, asset-based lending, life science lending, and specialty finance. Before SLR, Michael was a founding partner of Apollo Global Management, where he launched Apollo's first BDC and helped build its credit platform from the ground up. He got his start at Drexel Burnham Lambert in 1987, working under Leon Black in the M&A department. Michael expects rising defaults in private credit as 2021 vintage loans, underwritten with weak covenants and high leverage, come up to maturity. We also discuss the early days of Apollo, raising the first significant BDC in 2004, which launched the massive growth in the industry, and how SLR seeks complexity as a competitive edge. Please enjoy my conversation with Michael Gross.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Tell us a little bit. You didn't decide to become an English professor.
Great question. As you highlighted, my father's a professor for decades at Michigan State University, and I, at an early age, decided I wanted to go the business route. And the interesting thing, my grandfather was an entrepreneur, and I always admired that. And so from a very early age, I had the idea that I wanted to go to business school undergrad, which after spending a year in Israel, my freshman year, I ended up going to University of Michigan, which is now called the Ross School of Business, and was a business and accounting major. And that was my passion from the beginning. I wanted to be an entrepreneur and be in business. I was well read though as a child, as son of a professor, so I got all that benefit.
And so tell us what you did with your bar mitzvah money.
It's actually my brother's bar mitzvah money.
Okay.
So when I graduated from Michigan, back then there was the big 8 accounting firms. Now there's 4? 3 left? I don't know what there is. I was an accounting major. I had job offers from all 8 accounting firms, and I accepted a job. But at the same time, my business school best friend and I came up with this idea to create a business. This is back in 1983, so before people had computers or laptops or desktops for that matter, before there was word processing. And so we had the brilliant idea of trying to use technology to create a word processing center to process students' resumes, dissertations, cover letters, things of that ilk. And so we launched a business called the Wizard of Word Processing, brilliant name. And I had no money to speak of as a son of an English professor. I'd already spent my bar mitzvah money on my college education. So I had the brilliant idea to borrow my brother's bar mitzvah money as my seed money to do that. Full disclosure, I paid it all back with interest within 3 or 4 years, but I did borrow the money much to my parents' chagrin and use that along with my friend's money, I'm not sure where he got it from, to go secure a bank loan to launch that business. Terrible business.
Seemed good at the time though.
It seemed a great idea at the time. When I found myself in the middle of the first school year that we're doing it, up at 2 a.m, doing someone's cover letter who was a junior the year behind me, I didn't really enjoy that so much. We quickly realized it wasn't a scalable business, but what we stumbled upon from doing it was a need to supply computer software and peripherals to the academic community who were just starting to get IBM desktops. And so we morphed into a computer distribution business.
What kind of computers are we talking about?
IBM desktops, personal computers. They weren't personal, but they're much larger than they were today. They're probably 2.5 feet by 2 feet by 8 inches deep. And we became a gray market dealer where we would buy IBM PCs from other dealers, and then we would install all the guts within them, the memory chips, the disk drives, the communication boards, and would repackage and sell them. We eventually, through just a series of events, became a major supplier to General Motors. Back then, when a purchasing agent or a technology person wanted to get something, they would do whatever they can to get it in by trying to figure out how to do it because it wasn't well known. And we became a very major supplier to General Motors until EDS bought. EDS was acquired by General Motors to do that for them. We had grown our business from $0 to $18 million a year in 1984, so it's a lot of money. We opened offices in New York, Chicago, St. Louis, and Minneapolis to support the growth we had. And we found ourselves in the position that GM was about 75% of our sales, which anyone, even if you didn't go to business school, you don't want to concentrate your business in one customer, but it was kind of hard to turn away the business as it was coming in. They were just giving it to us. But when GM bought EDS, for the first 3 or 4 months of that ownership, we were the supplier. We helped EDS support General Motors as the proliferation of desktop computers started to take over. But then, as we affectionately called it Black Friday, I got called into their offices at the Tech Center in Detroit, and they said, "We really appreciate your service. We're going to take all the relationships to your suppliers directly. We're going to do it in-house." So we went from $12 million a year annualized in sales to General Motors to 0. And we had to go lay off at age 23. I was 23 or 24, lay off half our workforce, which was like 30, 40 people, and then try to stay in business for a while, and it didn't work out. And ended up liquidating and went back to business school.
Then you took the unusual step of joining Drexel in '87. How did that come about?
For me, it wasn't unusual. For whatever reason, I had in my mind when I went back to business school that I wanted to go work on Wall Street as an investment banker. In fact, before I went to business school, I came to New York and went around the street and tried to get my resume to place to get hired before going to business school. I was basically told that notwithstanding my 3 years work experience, I was to be treated as a graduating college student and start from the very beginning. I didn't really want to do that. I went to Northwestern, which gave me the benefit of the fact that they had a 4-quarter program. So if you had an undergrad degree in business, you can go get your MBA in 1 year, which financially and emotionally made a lot of sense to me. So I started in June, graduated in June, which meant within 3 or 4 months of being at school, you start interviewing for jobs coming out of grad school. So I interviewed pretty much every investment bank of the street. First Boston, which doesn't exist anymore. Lehman, which doesn't exist anymore. Merrill Lynch doesn't exist anymore. Bankers Trust, Drexel, et cetera, et cetera. It's an interesting question because during the middle of all this, Drexel was already under investigation. Milk was under investigation. Drexel was in the headlines all the time for the government being after it. And I'll never forget this. When I told my friends, I said, I got a job offer from Drexel and I'm going to take it. And they looked at me and they said, "Are you crazy? Look at what's going on. They're under investigation." And I said, "I hear you, but they do the kind of business I want to do. They're funding and financing entrepreneur-driven companies. It's not boring investment grade stuff. It's not boring IPO. It's actually getting the weeds and understanding companies and how to help them finance themselves," which was very exciting for me. And I said to my friends, I said, "You know what? I'm 26 years old. I'm not married. I don't have any kids. And if they go bankrupt in 3 years, I'll find another job." Lo and behold, I didn't predict it, but they actually went bankrupt in 3 years, and I did find another job. And the experience I had at Drexel was unforgettable. I would say it's really the launch of kind of the career I've been able to have. It was the most amazing training ground, the most entrepreneurial spirit. The people I worked with were phenomenal. It didn't matter where you went to school, how many years experience you were. It was a complete meritocracy. So if you performed, you got more thrown at you, and I loved that, and I thrived in that environment.
What kind of deals were you guys working on?
So it really ranged. Like one of the first deals I did was I worked on the leverage buyout of Celestial Seasonings Tea, based in Colorado, for a private equity called Vestar. It was a $30 million leverage buyout, and it was run by an entrepreneur who didn't know what a leverage buyout was. And so I got to spend my time really due diligence of the company, understanding where the source of the revenues were, what the risks were, and only putting together a financing package and help them finance it. Or it ranged from a very large deal for someone like KKR buying Owens, Illinois, a packaging company. But it was just extremely creative. No 2 deals were ever the same. We worked literally 7 days a week, probably 16, 18 hours a day. And I loved it until it went bankrupt.
What do you think about the legacy of that firm now?
The proof's in the pudding. If you look at the diaspora that took place and the number of businesses in the alternative asset space, whether it's private equity, private credit, that are either founded by or run by Drexel alumni, is incredible. Ares, Apollo, Canyon Partners, Crescent, Leonard Green, and the list goes on. Howard Handler, who runs Jefferies, Moelis & Co. The network is phenomenal. Interestingly enough, when Drexel blew up, certain firms refused to interview people from Drexel. Goldman, Solomon Brothers just they don't have anything to do with us. And when I looked for new jobs, they wouldn't interview people like us. So Drexel blew up in February of 1990. It came pretty abruptly. And at the time, as we were cleaning out our desks, Leon Black, who was running the M&A department at Drexel, came to talk to Mark Rowan and myself. Mark and Rowan and I were like best friends and colleagues throughout. We were best men at each other's wedding. Neither of us were married at the time. And he said, I don't know what I'm doing yet, but when I decide to do it, I'd love to have you guys come join me at some point. Great. I couldn't wait around. I was unemployed, so I started looking for jobs. I interviewed with some of the larger investment banks, and having worked in Drexel's culture, I found it really hard for me to find my way into doing that. And then I had the opportunity to interview with Eric Gleacher's newly formed firm. Eric Gleacher was a leading M&A investment banker from Morgan Stanley, and he spun off to create his own business, Gleacher and Company. And I interviewed and got the opportunity to be the number 6 employee there. And I was very excited about it. But this was probably like May, 3 months after Drexel blew up. But I wasn't sure yet if I wanted to do that. And so I went to see Leon, and I said, what are you up to? He says, I'm raising money to do some principal investing, take advantage of the distressed debt environment. I'm not done. We're not done yet, but if I do, I'd love to come join me along with Mark. And I said, I have this job offer. He goes, what do you think I should do? He said, you should take the job. And then if I'm successful raising money, you should quit and come join me. I said, I'm not going to do that. I can't do that. I'm not going to go into a job knowing that hopefully something else better is going to happen. So I said, what about if we just come join you now? You don't have to pay us. We'll help you with the fundraising process. And so that's what happened. Mark and I moved into offices with him and John Hannon somewhere on Park Avenue.
It was Bennett LeBeau's office.
Bennett LeBeau's offices, exactly. Yes, because Bennett LeBeau is an old-time client of Leon. And so moved in these small offices and started raising money. And I look back, that's probably one of the best risk decisions I made, because it allowed me to become a founding partner of the firm and get pretty favorable economics as I started.
That was actually a pretty tough time. There was the S&L crisis, there was the real estate recession, there was a New York banking recession. The high yield bonds were plummeting because there was no buyers anymore.
Yep.
Tough time to raise a fund, but I guess
A great time to invest in the fund.
Credit Lyonnais, I think it was 400 million or something?
I think it was the initial amount. It rapidly grew above that. I don't recall the exact number was. And the story I heard was that Leon got a call from a very French sounding name, is Thierry de Villachet, who said, I'd love to talk to you about setting up an M&A group for us for Credit Lyonnais Bank. And Leon's like, been there, done that. If you have people who want to talk about, I'd talk about investing money for you, because it's a great opportunity today. And that's how it transpired. And they very quickly, to your point, came up with $400 million. It rapidly grew, and it put us in a position where we could take advantage of that dislocation that existed, because to your point, there were no buyers of high yield bonds. There were no buyers of distressed debt. And so the way we launched Apollo was to be a distressed debt investor by taking advantage of that, buying up existing high yield bonds or bank loans of companies that have become over levered or had need to refinance. But the big difference for us was, whereas most people in distressed debt back then and today were focused more as a trading activity, we viewed it as a means to kind of back our way into a well-priced leverage buyout by willing to target companies we actually want to buy, and then we want to equitize the bonds we bought and turn that into equity to take control of the companies.
What did you learn from launching a BDC that informed what you do today?
So fast forward, you skip 13 years of Apollo, that's fine. So for 13 years of Apollo, the firm was essentially a private equity firm. We morphed from being a distressed debt investor to becoming a more traditional private equity firm. We did dozens and dozens of transactions. I was very involved as a founding partner. And then in 2003, we as a firm decided that it was time to diversify beyond private equity. And today, Apollo's biggest business by far is credit. That was a place we decided to diversify into. And as one of the founding partners, I volunteered to take on the role of trying to create the first of our credit businesses. And so in 2003 and 2004, I did two things. One is I launched a distressed debt fund that we launched through JP Morgan. And the other is, to your point, I created Apollo's BDC. And what's interesting about that is today, everyone and their mother and brother and cousin and sister-in-law has at least one BDC. Back then, no one knew what a BDC was. The BDC I took public for Apollo in April 2004. 6 months prior to that, I never heard of those three letters be used together as BDC. But what's interesting was that I'll never forget, it was early December of 2003, and I got pitched by a UBS banker about a BDC. They had just taken public a very small BDC called Technology Investment Corp. It was meant to invest and lend money to technology companies. And this banker, Hal Bennett, said, hey, maybe you guys could do something like this. And my first glance, I poo-pooed it. Like, we're Apollo, $125 million, it's a public vehicle, what do we do with this? Sarbanes-Oxley had just become a big thing, like who wants to run a public company? But I took the prospectus and I put it in my bag to take for the weekend, and I went to Chicago for bar mitzvah, and I woke up at 2 a.m. with this epiphany. And I sat down with the prospectus and I rewrote it, to say, this could become Apollo's mezzanine business. Because the attraction was that the BDC is permanent capital, so you never have to return to investors. You can invest in highly liquid investments. The fee structure is very favorable. And I was looking for different ways to put our firm into credit. And what I realized was that, having been a private equity investor for as long as I was, there's no way I was going to be a credit investor buying liquid loans and high yield bonds. I need to be able to do real due diligence from the inside. And that's what the mezzanine business allowed me to do. And so I went back to UBS after the weekend and I said, look, if I can convince my partners to do this, and you can tell me you can raise $500 million in this blind pool BDC, maybe we'll do that. And so I debated with my partners. There was a lot of pushback because no one really liked it being public. No one ever had a permanent capital public vehicle before, and all the risks associated with being public in terms of Sarbanes-Oxley. But we finally came to the conclusion that it made sense to do, and so we filed for $500 million. And on the eve of the roadshow, we upsized to $750 million, and we priced $930 million. And so all of a sudden, in April 2004, we had a balance sheet of $930 million of cash and no investments and no investment team. I felt like the dog that caught the bus. I'm like, oh my God, I finally got here. Now what am I going to do? I've never been the CEO of a public company before. I never run a BDC. And so what we did very quickly is we utilized the private equity team to help underwrite and source liquid loans to get yield in the portfolio, while I hired and built out a team to do mezzanine lending, to lend money to private equity-backed companies. And so then we morphed the portfolio from liquid loans into mezzanine loans and built a portfolio of $3 billion over 3 years. Fortunately, back then, mezzanine lending is not attractive at all today. Back then it was very attractive because the markets were not efficient. You could lend money at 12 to 15%. You can get warrants. Your leverage is only 3.5 to 4.5 times as opposed to 7 or 8 times today in senior secured loans. And you actually get covenants as a mezzanine lender. So it was a very attractive time to do it, and one that allowed me to really apply a private equity style approach to credit underwriting as I built out that business.
And probably not much competition.
There's mezzanine lenders competition, but not terrible. And there was no opportunity back then as a lender to participate in senior secured lending because all the commercial banks before the great financial crisis provided that capital very efficiently, very cheaply. So anyone doing, it wasn't called private credit then, but anyone doing private credit then was doing mezzanine lending and not first lien senior secured lending like they are today.
After you left Apollo, you raised a successful SPAC. What do people get wrong about SPACs?
I'm not sure they get it wrong. I raised a SPAC in the summer of 2006 as I was leaving Apollo and started this firm, SLR Capital. I did it as an opportunity to potentially take advantage of buying an attractive company. In hindsight, I don't think SPACs are great structures. I think the incentives are all misaligned.
What was the appeal then?
Well,
you raised a considerable amount of money.
$300 million. It was like the largest SPAC at the time. Back when I counted about BDCs, there weren't 50 of them out there. There were like 2 or 3 out there. So the competition wasn't extreme. For me, it was an opportunity to still take a private equity approach to potentially buy a company and running it. But it's a very difficult, flawed process. You have to go find a company. You have to find them willing to take the risk of a shareholder group agreeing to or not agreeing it. And one of the negatives about the structure is the day a company is bought, all of a sudden, all this value, regardless of performance, goes to the sponsor of the SPAC. People's interests are not aligned. And so I've been very lukewarm about them ever since I did one 20 years ago, 18 years ago.
Tell us a bit about the founding of SLR. I understand you met your partner Bruce at Drexel.
So Bruce and I both worked at Drexel, both under Leon Black in the M&A department. And Bruce also happened to go to Kellogg as well. So he was actually part of the team on campus recruiting me to come to Drexel because he was a year ahead of me. So we've known each other for however many years, 40 years. When Drexel blew up, as we talked about, I went with Leon Black and Apollo. Bruce went and co-founded a boutique firm called the Argosy Group with several other Drexel partners, where they continue to finance middle market companies. He then, when they got merged into CIBC, he took over running all of their leverage lending business for the Canadian bank. Also, Bruce and I, we have 9 kids between us. All of them went to the same school, K through 12, and 5 of them went to the same university, and we live 5 blocks away from each other. So there's a lot of relationship there. So when I left Apollo, and the reason I left Apollo is I wanted to build out an independent private credit business as opposed to being tied to another alternative asset manager. I made one phone call to find a partner, and that was to Bruce, because he brought the experience and skill set that I thought we needed in terms of transition the business to becoming a sponsor-backed sourcing business of private credit. So in the summer of 2006, where he still was at CIBC and I had left, we met on many occasions at Hampton Coffee out in Watermill and plotted out what a firm would look like and culture what it looked like. And 2 things we spent a lot of time talking about was from a culture perspective and an investment alignment of interest perspective. The first was that we view, and still do today, that private credit investing is truly an alternative asset investment business, because we're investing in highly illiquid loans that you can't change your mind on once you make them. So you have to get it right going in. And so for us, back to my comment about alignment of interest is critical. We want to always treat this business as a principal investing business. So from day one, he and I and the whole team have invested a tremendous amount of money in our funds, and we never take money out other than interest and dividends. That creates true alignment. The other is that from a culture perspective, we wanted to build a team that could be with us for a long time. And excuse my French, we basically quickly said we want to have a culture or a firm of no assholes. We had both come out of somewhat challenged cultures. And when I look at our firm today, some 20 years later, we're actually just hitting our 20th anniversary this month. The people running our businesses today are people that we hired when they were in their 20s, 18, 20 years ago. They've been to us throughout. We have virtually no turnover. And that's really critical because what we do is we do a highly complex lending strategy, and it requires a lot of cooperation and interdisciplinary work to get that done. And so people have to work as a team. The other reason for me, the importance of having interest aligned was that one of the things I learned from moving from private equity to private credit is that in many respects, the underwriting is very similar. You're trying to predict how a company's going to do in a levered environment over a 5-year period, whether you're lending to it or whether you're doing the equity. So you're doing deep underwriting to figure that out. But the return profile is so dramatically different. In PE, you can be a good investor and be right 3/4 of the time. Why? Because your 40% return deals offset your losses. In credit, where you're underwriting to high single-digit returns, you don't have anything on the upside to offset your losses. And so you have to write 99.9% of the time. And what I quickly learned at Apollo, building out the business there, was that the best way to make money in credit is to not lose money. And the best way to not lose money is make sure that everyone around the table who's investing has real skin in the game and says, I'm putting my own money in this loan, and if I don't like it, then I'm not putting my investors into it. Because the other thing I also learned in credit is, whereas in equity, you get paid to take risk. You're trying to make 30-40% returns, so you're taking risk, but you have the upside. In credit, we don't get paid to take risk. And unfortunately, the return profile is asymmetrical. The good loans get taken out in 2 or 3 years because there's not a lot of call protection. The bad loans you wish you never made. And so what we've taught people here culturally is that if anything has any risk, it goes in the life's too short category. No matter what the yield is, no matter what the return is, if we think there's risk of not getting paid back, we're just going to say no.
How do you define that risk?
It depends on the strategy. So our business, I mentioned, it's more complex. The traditional private credit lender today is primarily in cash flow lending to private equity-backed companies. We do that, but it's a very small part of our business. We've built out several very complex asset-based lending businesses on our platform. We've built a team of 330 people doing that. So in cash flow lending, some of the critical factors that we must have, forget about the company, is documentation and control. The world has evolved into, in cash flow lending, in a world where there's virtually no covenants. We don't do that. So if we can't get a covenant, we're pencils down. I'll give another example. In asset-based lending, where that's not an issue. Asset-based lending, the documentation is as strong as it is today as it was 15 years ago. And not only do we have covenants, we have borrowing bases. But the biggest risk in asset-based lending is fraud. And fraud comes in many forms, but it's preventable. So one of the things that we do in assessing risk is the first thing we do when we start to analyze a company from an ABL strategy, once we get a due diligence deposit to do our work, we spend that money on a background check on the principals and founders. If anything comes out shady or negative, pencils down. Again, from the life's too short category. If they did something bad in the past, they may do it again. And so if you look at, and I'm bouncing around a lot, but if you look at the big blowups that took place over the last year, whether it's Tricolor, First Brands, or the third one, if you look at the background of the principals and founders, there were issues. There were yellow and red lights that should have made it obvious for people not to lend to those companies. Having built out a platform and a business that allows us to invest when the time is right in different strategies and not being forced to invest all the time in a single strategy. So if you look back historically at cash flow lending over a 20, 30-year period, the default rates on average are fairly low, 2 to 3% a year, or less than that rather. But there are periods of time when they spike. If you invested a bunch of money heading into the great financial crisis, you would have done very poorly in credit. If you invested a bunch of money heading into COVID, you would have done poorly. And arguably, those who invested a lot of money in 2021, when rates were zero, leverage was 7, 8 times, and 25% of the portfolios went to software, you're probably not going to do so good. But if you're in one business and that's cash flow lending, you're going to be fine. You're going to be investing it all the time. What we've done is we created a platform where we have cash flow lending, we have receivable financing, we have inventory financing, we have equipment financing, we have life science lending, and we have lender finance. We run all our businesses like multi-strategy funds, so it allows us to step back in any given period of time and say, this is a good time for this strategy and not for this strategy, and be able to reallocate capital amongst it and not be forced to invest all our capital into one environment. And that's what our LPs like a lot about us, because we offer this kind of differentiated source of return, but importantly, we're able to move around the market where we see where it's best. I'll give you an example. Prior to 2019 to 2020, we were probably half of our business was cash flow lending. Half was in our specialized asset-based lending strategies. When 2021 came along, we were at the tail end of the zero interest rate environment. There was a ton of money chasing credit in LBOs for private equity sponsors at the upper end of the middle market. And we saw yields go down to 6 to 7%. We saw covenants disappear. We saw leverage go to 7, 8 times. And we saw 20, 25% of loans go into software. We hated that. We just didn't think it was a good investment business. So we went from 50% of originations in cash flow lending to sub 20%. Why? Because we had the ability to take our capital and put it into the higher yielding, more complex, less risky asset-based lending.
Why did you like those businesses?
In asset-based lending, you're not financing speculative cash flows. And you're not generally financing private equity sponsors who are looking for every last nickel or every last minor covenant. We're lending against things that we can diligence, like receivables, like inventory. We're lending against liquidation value of them. And we're doing it in highly structured facilities that allow us to determine when to lend against them and when not to lend against them. 2022 came along and it became the golden age of private credit. Why? Because the syndicated loan market shut down. So private equity sponsors couldn't do traditional borrowing through the syndicated loan market. The CLO market had shut. And so people like Blackstone were able to do $1 billion, $2 billion, $3 billion private credit, senior secured loan facilities at very attractive yields, 11, 12, 13%. Why? Because the PE sponsors didn't have anywhere else they could go. And so that became the golden age of private credit. It didn't last very long. It probably lasted 6 to 9 months. And the way we took advantage of that was we observed the same thing. Yields are very attractive. But instead of participating in these very large, huge club deals, we went back to our existing borrowers and borrowers we had turned down in the past and said, okay, you're owned by a PE firm. You're a mature buyout now. You've been private for 2 to 3 years. You've delevered, and you have a desire to grow through acquisition. And so rather than reopening your entire credit facility and refinancing it at these unattractive rates, we'll provide you capital by lending money into your existing credit facility to give you source of capital to do acquisitions at the same pricing, but we'll take significant OID. We'll take a discount. So instead of, if the loan's 100 cents, we'll buy it at 95 cents so that we can look at a return over a 2 to 3 year period to get not only our coupon, but that 5 points of upside. And so we were able to underwrite deals, the same situation, 11 to 13% in mature buyouts, levered 4.5 to 5.5 times with a covenant. But the interesting thing is that for us, we knew that was going to be a trade, because we knew the minute that the syndicated loan market came back or credit spreads tightened, every PE sponsor would be banging on our doors and say, okay, SLR, thank you for that loan, but if you want to stay in it, you either have to reprice and reflect what the market is today, where it's going, or we're going to take you out. Most people in private credit, virtually all of them, accepted the repricing. Why? Because they didn't have another strategy to put it back into. And from a cynical view, these old managers get paid on assets under management, and they didn't want to take money back and reduce their fees. And so you can look back at the private credit market beginning in early 2023, and quarter over quarter, yields across people's portfolios in private credit firms and in public BDCs have gone down about 25 basis points a quarter. Significant degradation of returns. For us, our response to the repricing was, as a lender, we'd love to get paid back, pay us back, and we'll redeploy the capital into these other strategies. And so since the beginning of 2023, 75% of originations has been in our specialty lending strategies and only 25% in cash flow. What that's allowed us to do is to keep our asset level returns still above 11 to 12%, while the rest of the world in traditional private credit is back down to 8 to 9%.
And you avoid the LMEs.
Yes, that's a critical thing. You said that. So the vast majority of what we do, we're the sole lender. So in asset-based lending, in lender finance, in life science, we're the sole lender of these companies. So not only are there no worries about LMEs, there's also no worries about the things that happen to First Brands and Tricolor, where people are pledging collateral to different lending parties without awareness of others.
So maybe we could dig in a little bit how you do that actual nitty-gritty diligence.
Yeah, so I'm glad you mentioned that. So we manage about $14 billion of capital as a firm. We have 330 people, which is an awful lot of people for that amount of capital.
And 18 offices, correct?
Yeah.
Okay.
Yeah, the vast majority are here in the New York office where we're talking, but there's 65 here. The others are spread out. They're more origination and underwriting functions. So we have a lot of people in the street originating deals. Depending on the strategy, we're originating deals from small businesses. We're originating from private equity firms. But one of the things we look to do is to lend money in areas where it's less efficient and it's more complex. So one of the things we're spending a lot of time on today is, you mentioned LMEs and private equity and those kind of capital structures. One of the things that took place is, because of loose documentation, many of these private equity owned companies have the ability to pull out working capital assets from the bank facility and finance them discreetly. So that means receivables and inventory, things that we like collateral that we can turn into cash in 60 to 90 days, that we know we can diligence and underwrite and then ultimately service. And it's also a business where, back to complexity, it's not something where you can just raise your hand and say, I'm in private credit and I'm going to do lending against receivables and inventory. You have to have the technology in place and the ability to monitor it to do that. You can't just jump into the business. It's not simple. So one of the deals we are looking at or have done is, I mentioned before, we have a lot of expertise in healthcare. We actually own on the platform a healthcare asset-based lending business where we lend against government-backed receivables, insurance receivables. The biggest risk in healthcare is whether you get paid or not. And so having that expertise on the platform or knowing what gets paid and doesn't get paid helps us across the platform. But we were able to lend money to a company that is fairly sizable, has 125 million of EBITDA, had a traditional credit facility in place, but we're able to carve out the receivables and finance discreetly. Now, the interesting thing is, why do PE sponsors want to do something like that? Why do they want to carve out assets and finance it discreetly? Because they have potential liquidity issues down the road, refinancing issues, cap structures are put in place in 2021 that can't necessarily get refinanced in the current environment. And so rather than bringing in expensive junior capital or putting in more equity, by financing the working capital assets, they can get a bespoke solution without paying too much. And the interesting thing is, there's a lot of ways that we make money in asset-based lending. Traditional credit, the way you make money, you have your coupon and you have your SOFR. So the spread over coupon over SOFR, that's how you get paid. And maybe you get a little fees. In asset-based lending, we get all that as well, but we also get significant fees. We get upfront fees, we get collateral management fees, we get call protection, we get unused fees. And so the facility I just talked about in healthcare, nominally it's priced at SOFR plus 400, which sounds very attractive. But when you take into account all those other fees I just mentioned, our expected return is 11.5%, not the 8 or 9% you would see from that. So it's that complexity that allows us to charge more and have a unique business proposition.
How did you find that particular one?
I believe that one came from our team that covers private equity sponsors.
And what's your sweet spot?
So it depends on the strategy. From a platform perspective, we can hold as much as $250 million in a given situation, and we'll do that where it makes sense. But we also have businesses that make loans as small as $3 million. We have a factoring business that provides factoring facilities to companies. And one of the things we love about factoring is, this is fascinating, we came out of the regional banking crisis a couple years ago. And one of the implications of that is that banks, again, are being forced to pull back from certain businesses that the Fed would provide a fairly high capital charge against. The Fed kind of assesses the health of a borrower, and based on that, they put a capital charge to the bank against that loan. What the Fed doesn't look to, they don't look through to the collateral of the borrower. They look at the borrower's financials itself. What do the audit financials look like? Have they lost money recently? How large are they? There's thousands of companies across the US that would be criticized assets by the Fed. But in many cases, if you look through to their collateral, the collateral is investment grade. So in many of our factoring facilities, when we look through, we're actually financing receivables from people like Amazon, from Google, from Microsoft. And the borrower can't afford to wait the 90 to 180 days to get paid by those vendors. And so instead, they'll factor receivables to us at a 12 to 15% return. And so we're lending money to what otherwise would be a B- or triple C credit, but our collateral is investment grade, and we're charging B- or triple C rates against it. And so again, complexity, we have to go verify these receivables. We have to be on the phone with Amazon and say, was this item actually shipped? Do you owe the money? When are you going to pay it? We actually create lock boxes in many cases, so the money comes into us. And once we verify it's been paid back, we then decide how much money to get back to the borrower. So our business, as opposed to most private credit, is more like we're like a bank in many respects. We become the bank for these companies. Creates a moat where people just can't, again, as I said earlier, just wave their hand and say, I want to get in this business. You can't do it overnight. Going back in time again, when we launched the firm in 2006, unfortunately, we ran into the great financial crisis 2 or 3 years later, which delayed taking our BDC public by a couple of years. But we, like everybody else, had an aha moment when the GFC happened. The aha moment was banks were being forced to exit traditional direct lending. So senior secured lending became an opportunity. And also importantly, we also realized that as a senior secured lender with a little bit of leverage against it, you can get better returns than as a mezzanine lender, and you can sleep much better at night. So everybody in private credit, led by Ares and Golub, went headstrong into direct lending on a senior secured basis for private equity companies. We did the same thing, but we noticed something different. We noticed that the banks were also being forced to exit these asset-based lending businesses. And so whereas everybody just went into cash flow lending, beginning in 2009, we started doing asset-based lending. And the first thing we did was what we call lender finance, where we lend to other commercial finance companies against their highly diversified pools of loans. And so because we've had a public BDC since 2010, we're rated investment grade. And so we borrow money very cheaply, both from the banks, from the investment grade insurance company market. There are hundreds and hundreds of other successful commercial lenders that are smaller, that are not investment grade, that people like JP Morgan and Goldman Sachs and Wells Fargo won't lend to, but we will. So we'll create bespoke facilities for them where we're underwriting all of their loans and lending against their loans. But one of the things that we mistakenly, or accidentally rather, discovered was that by lending to these companies, because the duration is really long, it's typically 5 to 7 years, it began to become like an R&D facility for us. Because we got so involved with these businesses that we really learned them from the inside over that 5 to 7 year period. And in most instances, we come out of the experience and say, great loan, happy just being a lender to it. But in certain cases, we come out of it saying, we like that business so much, let's go into the business for ourselves. And so we look at our platform today, there are several businesses on our platform that exist because of having lent to a competitor in the business. So back to Apollo again. Apollo bought MidCap in 2014, I believe it was. MidCap was a commercial lender built by Howard Woodruff, primarily in healthcare. It was owned by Jen Starr and Tom Lee. We were the only non-bank lender to them. We lent them $85 million as a second lien loan. And so we got to see how the company was run from the inside. And there were three businesses in that business, all healthcare related. One was a real estate financing business, financing nursing homes and small hospitals. One was a healthcare ABL businesses, financing receivables. And the third was a life science lending business. When we exited the business, we came to the conclusion that we liked two of the three businesses, the ABL business and the life science business, that we wanted to get into ourselves. So we did two things. We went out and acquired a healthcare ABL business. We've now owned that since 2012, 2013. Been a very successful part of our backbone, gives us our healthcare expertise. And then we went and hired the team from GE Capital that did all the life science lending for them. And what's interesting is when we first got involved with MidCap and I heard about life science lending, it scared the crap out of me. It doesn't sound like a credit business. You're lending to venture capital-backed companies that are burning cash, who are trying to create life-saving drugs and life-saving medical devices, and sounded really risky. But what we saw from the inside was that they were lending to very late-stage companies, all on a first lien senior secured basis. And by the way, there were only 5 competitors. And so that's why we decided to go hire the team from GE. They had built the exact same business on GE's platform. So it's those kind of events that led us to get in some of the business that we're in by having lent to them first.
How long does it take you to train a portfolio manager?
If I look at portfolio managers today, they've been with us on average for 16 to 20 years. And they all started as associates. So I'm not saying it's 16 to 20 years, but they've been portfolio managers for 8 to 10 years.
But how do you train somebody to do this kind of work?
What's interesting, if we look at the commercial finance businesses, the ABO businesses, which we've done through acquisition or bringing out teams, they had 20 or 30 years experience before we brought them on. And they had track records already. So the good news is we didn't have to train the people doing the ABL strategies. They were already trained. We spent a tremendous amount of time up front to make sure they shared our culture and our vision and our values. But the people who kind of run risk management here or run certain strategies here, it's trained by example. It's trained by being here day to day. It's one of the big reasons why when COVID hit, we were one of the firms to get back in the office in person the quickest. This business is so much about a collaboration that you can't collaborate through Zoom call. And the collaboration happens here by people just walking down the hall saying, what do you think about this? Or what do you think about that? How do we come up with a solution? Because one of the things I love about this business is that every loan is different for what we do. And it takes that creativity and collaboration to try to find a solution to what the borrower is trying to accomplish. People love working here because no two deals are alike. And our junior people come here because they have the ability to get trained in the different disciplines, different strategies we do. And at some point, they get to raise their hand and say, hey, Michael or Bruce, I'm really passionate about this. Can I go take a more senior role in this strategy? And that's what happens. I look at people running the different businesses. It's because they had the initiative to raise their hand and say, this is something I want to do. And so I think to your comment, it actually just came to mind, is that one of the things that's been successful about our portfolio managers is that they've each had the passion for the business that they run. And that, I think, really guidance to success. In fact, it's interesting. One of my sons is about to get married this summer, and I'll never forget, he's 31. When he was a teenager, and back then he used to wear a suit and tie much more often, he said, you know what, Dad? I'm never going to wear a tie to work. You know what? That's perfectly fine. You need to find something, follow your passion, and if you do that, you're going to be successful at what you do. And that's how it works here as well.
Who's a better candidate for a job here? Someone coming out of a regional bank or somebody coming out of private credit at Harry's?
Both. Here's why. So someone coming out of a regional bank is a great candidate for our asset-based lending strategies. They'll have the expertise, the experience of doing it. They'll have to be able to be more entrepreneurial quickly. So if it's someone who's been there for probably 30 years, it's probably unlikely. If it's someone who's been trained in asset-based lending and has that credit filter, they're more likely to be successful. But the challenge for people coming to our platform who are from traditional private credit firms, if you're an originator, the thing you want to do most is originate. You want to close deals. Our head of origination came out of GE Capital's training program. He was a CPA by background, so he has a tremendous credit filter. Our credit box is extremely tight. And so I would say sometimes people get frustrated working here because we say no very often. And as an originator who wants to point to the board, that can be a challenge. And so we do have trouble hiring people as originators from other PE firms because people's credit filter box is much wider than ours. Back to my earlier comments about we're willing to do cov light, people willing to do lower yield, we're willing to stretch on risk when we're not.
Is it a disadvantage that it takes you a certain amount of time to get comfortable with these loans?
At times. But I will say people who are looking to borrow money in the asset-based lending world are not accustomed to the same time frames as private equity. In PE, when the market is flexible and buoyant, it's an environment where a PE firm will send out a term sheet to 15 potential providers and they'll say fill in the blanks for your covenants for a yield. That doesn't exist in asset-based lending. Because when you do an asset-based lending loan, you have to go in and do like detailed field work, at least you should. They're accustomed to having to wait, and they're accustomed to having to narrow it down to one person to do the work with because you can't do multiple field audits. So I don't think we ever really lose business because we're too slow. We're actually very quick to say no if we know it doesn't fit us. We're not going to go spend time with stuff that doesn't make sense. But people also know in the asset-based lending world that if we say we're going to do something from the early go, we're going to do it and we're going to close.
That would make them sticky as well.
The asset-based loans are definitely more sticky because there's no repricing. There's no such thing. They're not, again, to my earlier comment, they're not sending a term sheet to 5 other providers and say, can you beat these terms once these SLR's been there for a while? And also because, as I mentioned earlier, we're like their local bank. It becomes a relationship. In a factoring relationship, if the factoring slows down, they're not able to ship goods anymore. And so it's more about liquidity and certainty of liquidity than about what they're paying for it. And that's what we love about the business.
Do you ever get stuck with collateral? Do you ever get the warehouse full of toasters?
We've had to liquidate. I'd say in our receivable financing, we haven't had to really liquidate on the receivable side. We have had to on inventory. It happens maybe 3 to 4% of the time. And fortunately, we have a team that has experience in doing that. What we do when we underwrite an inventory loan, we hire going in the liquidator that we would use to liquidate. And we get full appraisals, we develop a liquidation plan, we put it in our drawer. And so if it does happen, we pull it out of the drawer and we go right out and do it. And what was interesting, we were petrified during COVID. Like, how do you do a going out of business sale during COVID? We liquidated a retailer, we did it online, and we got our loan fully paid out. It's all about, in that business, making sure you protect the liquidation, that you're very diligent about your advance rates against the collateral, and that you don't overextend. One of the things that we love about that business is embedded in our documents, it's also in receivable financing, is this term called permitted discretion. Permitted discretion gives us the right as the borrower, as a lender, to change the advance rate against a certain type of collateral. So for example, if we're lending to a retailer and we're observing that this particular set of goods is going on sale really early and not getting the retail value, we're going to adjust the advance rate on that. We're going to say, we're not going to give you, and for our advance rates against liquidation value, not retail, but we will say, instead of giving you 80 cents against that, we're going to give you 70 cents. On the receivable side, if we observe that a counterparty on a receivable is having liquidity issues and they owe money to our borrower, we're going to reduce the advance rate on that particular receivable. And so what's interesting, we get to be proactive and look prospectively at a borrower's profile and risk, whereas in cash flow lending, you only get to look at covenants if you have them in your rearview mirror. You don't have the ability to look forward. And so as long as you use the tools, which we do, to protect ourselves and not over advance to borrowers, it's just a phenomenal business.
What are your thoughts on litigation finance now?
We've looked at it, and the way we're involved today is to my earlier comment about how we evaluate business, we're lending to businesses who are in the litigation finance business. So we're not taking the actual claims ourselves, we're lending against a portfolio of claims that someone else has at a discount loan to value, and we like that. We're not doing consumer stuff, these are corporate litigations, for example. We're lending against people who are already in the litigation finance business against their portfolio of litigation claims.
How do you get comfortable with that?
We have 2 people on the team who've done it for a long time. We're doing it at a discount to realization. These are settled lawsuits, traditionally. not settled, but they've been adjudicated lawsuits. So it's about collecting the money. Sometimes things are appealed, but you have to deal with that. But it's a fine business. And it's a very small part of our business today.
How do you look as SLR grows? How do you look at organic growth versus acquisitions?
So we're one of the few people in the business that do acquisitions. We've done probably 8 to 10 acquisitions since we started the firm. And it's allowed us to set up kind of these new ABL platforms and then importantly to do add-ons underneath them. So we're looking to do a mix of both. Acquisitions are a very high barrier. We're not going to buy a business where we have to change the culture. We're not going to buy a business where we have to change a track record. So we're looking for businesses that a team has run for an extended period of time, that has the sophistication that we have, and also approach the business the same way we do, which is one of my criticisms about the alts business and private credit is it's become an arms race. People get paid for growth. If you're a public company, people are focused on growth. We tell the teams that we bring in our platform, if you don't grow, it's fine. We're buying you for your current return and yield. We're never going to put pressure on you to grow. We're going to depend on you to come to us and tell us when it's time to grow. We also tell them when we acquire a business, we're never going to sell you. We're not like a PE firm that's buying and trading these companies. We're buying it to integrate it into the rest of our platform. And for many people, that's not what they want. They want to be able to have a payday today and a payday sometime in the future. And so that eliminates a lot of the companies we look at. We're looking for people who want a home. And we're typically buying businesses from, they're either part owned by hedge funds or PE firms or commercial banks. Some of the businesses are really hard to grow organically. Things like factoring and receivable financing are very difficult to grow organically. So we've done a lot of our growth through acquisition there.
So you already mentioned 2022 was the golden age for private credit. Where are we in that cycle now?
I think we're coming upon some tough times for a variety of reasons. One is we have the vintage 2021 loans that are going to be coming up to maturity soon. Those are put together with very weak structures, highly levered in the zero interest rate environment, and companies haven't grown fast enough to counteract the interest rate increases. Software is a real concern because of all the other strategies we have. Our software exposure is sub 2%. We're not worried about that for ourselves. We're worried about it for others. We're not worried about it for ourselves. And default rates are starting to pick up. And the other kind of yellow flag I see is that if you look at the percentage of PIK interest income as a percentage of income today, it's accelerating. It's close to 9%. Ours is 2 or 3%. That to me is an early warning signal of potential defaults to come. What does that all mean? It means I think we're heading into a world of elevated defaults within traditional private direct lending, we're doing private credit. I don't think we're going to see the extreme that we saw in 08, 09. I don't see systemic risk that we had before. But my other fear is that a lot of the data that people focus on in terms of thinking about what loss rates are is irrelevant. So historically, Moody's has talked about the typical recovery rate of a senior secured loan is 70 cents on the dollar. Most of that data is from when covenants existed, which allowed lenders to get the table before the default. Given today that there's virtually no covenants, I would argue that the recovery rate is going to be sub 50%. So I think the loss given default will be higher. And I think we're finally headed to an era, which I welcome, frankly, where we're going to start to see a real bifurcation of results. Up until late last year, we were in the most benign credit environment for, 10, 12, 14 years. Rising tide lifted all boats. Everyone in private credit did just fine. And in fact, most of the loans that we passed on because we felt risky did totally fine. We would have been fine with them. I wouldn't have slept that night, but we would have gotten repaid. That's not the case today. We're in a world where you are going to start to see a real divergence of performance. And I welcome that because I think too much money has been raised for digital private credit. And hopefully this will slow it down and force investors to become a little discerning in who they give money to.
What's the divergence going to be?
Returns. I think you're going to see anyone who has elevated defaults to our earlier comment, you can't make up the defaults. People don't have equity in their portfolios to make up defaults. So you're going to blow a hole in your fund if you start having 3 to 4 or 5% defaults. And that's not extreme. And I think one of the things we haven't touched on is one of the phenomena within private credit today is the growth of these non-listed perpetual BDCs. It went from 0 to $250 billion in 5 years. $250 billion that had to get put to work. Because these non-listed BDCs are structured more like mutual funds and not drawdown funds. When the money comes in, the manager has to invest it within a 30 to 60-day period. Otherwise, the yield comes down. And so it put people who are raising these gargantuan funds in a position where they had to invest regardless of the environment to put it to work. And that's going to come home to roost at some point. And these are all owned by retail investors. We've all heard about and read about all the redemptions that have taken place. I think it's blown out of proportion, but it's an issue on the redemption side.
So in November, are you going to beat your best time?
Probably not.
How many marathons have you done?
This will be my 24th in a row. I did 4 or 5 years ago, I did win my age group at New York. I don't think I'll do that this year, but I'm just happy to be able to do it again.
Fantastic. Michael Gross, thank you for joining us and sharing your wonderful insights.
Thank you for your time. Appreciate it. Thanks.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.